Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. Today on our podcast, I have Darren Hassop. With over 25 years of retail banking and mortgage origination experience with some of Canada's top banks, Darren is a former bank executive who started his career on the ground floor. Having ascended through the ranks as a decorated advisor and manager, he forged his success on the support and loyalty of clients, partners, and staff. Recognizing the growing complexity of his clients' needs paired with the tightening bank lending guidelines, in 2015, Darren made the transition to the independent mortgage brokerage space and founded Mortgage Scout, a boutique brokerage nestled in the heart of the High Park community. His team is a uniquely qualified team of decorated professionals that built their business based on the fundamental of putting their customers first. And Darren's got an accolade of awards and finalists. He's a finalist this year, actually, for the Regional Brokerage of the Year by Mortgage Awards of Excellence. Welcome to the podcast, Darren.
Great to be here. Thanks, Harris.
Yeah, well, I mean, you've got a rich history of experience, and I was looking at just kind of going through your LinkedIn profile. You've been in the mortgage space, you know, and very successfully so since the beginning of your career. What made you get into mortgage brokering? Is that something you kind of just fell in, or is this something that you kind of looked at and you consciously was like, this is where I'm going? What was your kind of story?
That's a great question. You know what? I knew that I wanted to be a banker. It's funny, you know, you have conversations with parents about, you know, what you want to be and what you want to do. And I didn't really know what I wanted to do. And my dad looked at me and goes, you know, you're good at math. He goes, you should think about being a banker. And I said, well, okay. Did a little bit of digging, kind of to find things out. And for the first time, to my dad's surprise, I thought, okay, you know what? I'm going to take you up on your advice. I'm going to go into banking. So, you know, went into a specialized sort of banking program to sort of pursue a career while I was in school. I started working part-time. And, you know, once you get into the bank, it's got some pretty awesome pivot points. So, I mean, if you get bored in one segment, you can kind of go to another. And as I sort of came up through the ranks on the retail side, you know, becoming a personal banker, then becoming a financial advisor, I realized that kind of I had a passion for lending. It was something that I really enjoyed doing. And you know what, as sort of my experience, just working with customers and I found that I had that, you know, that draw to lending. I always sort of thought, okay, this is something I'd like to pursue. And I originally went the people management side, just to get retail bank and people management experience under my belt. And after sort of a stint as a branch manager, I thought, okay, you know what, I think I want to make a go of this. And, found out about commission sales and commission mortgage origination. So I thought, okay, you know what, I'm going to give this a go. And so I did. and I haven't looked back since.
Yeah, I don't know. I mean, there's few, I would argue, branch managers, and you get into that management side who are going to kind of leave that for a commission-based position. So,
Right.
and then,
Right.
and then I think, yeah, sorry.
Most don't.
Yeah.
Most don't. As a matter of fact, you know what? A lot of my colleagues were like, "Wait a second, you're going to leave management to become like a pavement pounder, to pound pavement, to kind of originate business, and you're you're leaving behind kind of guarantees and promotion opportunities." And I said, "Yeah, true. You know, I'm living behind security, but I'm kind of pursuing building something much bigger." And you know, when you take that big risk, and it's not for everybody. When in building something that's commission based, you leave behind those guarantees for potential for greater financial rewards. So not everybody is cut from that cloth, can handle that kind of pressure. And I thought, you know what, I think I can do this. It's worked out for me.
I mean, there's a lot of moving parts, and you have to be really good at all of them in order to be good at like the entire process. And there's I feel like
100%.
few people who can kind of get that going. I also saw that like even in working with big banks, you've climbed pretty high with the bigger banks as well, and then you moved into an independent brokerage. So
Right.
so what made you make that leap? Like, what's the impetus for that leap at that point?
Right.
If you're a director at a big bank, I mean, for a lot of people,
Right.
you're like, all right,
That's a big deal.
yeah, it's a big
Yeah.
deal. So to leave that, I haven't seen people kind of leave that and then start their own thing. I haven't seen it once, frankly speaking.
Yeah.
So what
Yeah.
made you decide to go from that to, okay, screw all of this, and I'm going to start my own thing?
Right. Again, not for the faint of heart. And to be honest with you, I wouldn't be where I am today if I didn't put that time and energy into and had solid footing building up my career at the bank. So I don't regret the time that I spent there. I don't regret the experience. I built an amazing network. I had exposure to you know, I had national exposure with the roles that I did with them. So, but they very much gave me the building blocks to succeed in this role. But you know, why? Why would you do that? Well, anyone who works in any kind of a hierarchy or major organization, you know, will tell you that, you know, that security and that comfort comes at a cost, right? So, as much as I really enjoyed the time that I spent there and the relationships that I had developed, you know, as you sort of ascend through the ranks, you know, the next level isn't so much about who's best fit or who's most qualified. It's a combination of things, and politics sort of come into play, right?
Yeah.
And as sort of you move up each level, at every level there's fewer jobs and much more competition. So eventually you kind of get to a point where you plateau and there's this waiting game. You're going to have to wait for a vacancy to happen. And, you know, the further up that, you know, that those rungs on that ladder, the more, you know, the fewer the jobs, the more competition. And it's, you know, the turnover doesn't happen as quickly either, right? So, you know, I was happy with my achievements of what I did in banking, but I was looking for sort of a new challenge. And the other thing that comes into place is legacy, right? You know, what do you want to be known for?
Yeah.
What do you leave behind? And, you know, frankly, for me, I wanted to do more. I wanted to be able to say that I built something. You know what? I think coming out into the independent space and building something for myself, it's something that I needed to do for me. Beyond the financial. I mean, listen, leaving the comforts of a guaranteed job as an executive with, you know, great incentives, stock plans, things of that nature. It's not something people easily sort of leave behind. But I thought, okay, you know what? Like, this is what I want to do, and I want to be able to duplicate my success in the independent brokerage space, and I want to build something that resonates, that matters to people. So that's kind of how I made that transition.
Yeah, no, I mean, and then you've moved into a successful, you've now developed a very successful brokerage. My question would be then, what makes you like a good mortgage broker? What is kind of that one thing that you say is, this is why I'm the best? Quick 10-second break. Are you finding this podcast useful? Do you want access to more resources just like this podcast? Sign up to one of our online workshops or our mailing list, and we'll send all the information you need right to your inbox. Good advice is hard to come by, especially in a market like today's. Sign up by visiting treadstonelaw.ca/MAS offer or click on the link below. Enjoy the rest of the podcast.
Right. You know what? I think your career path has a huge impact on who you are and what you bring to the table. And, sadly in this industry, the bar to get in to be a broker is super low, right? The average productivity per agent, if you look at the industry averages, what an average mortgage producer generates in volume on an annual basis, it's embarrassingly low. And so one of the things that we sort of saw as institutional guys that kind of came up through the ranks, we pounded pavement. We started on the ground floor when it came to banking. So I'm talking about being a frontline teller and being a customer service officer, being a personal banker, being a financial advisor, being a business advisor. All of those things in my journey helped me understand people, helped me understand financial needs, helped me understand the intricacies of business and financial statements and revenue. So, when it comes to being a mortgage broker, your job is to be an originator, right? Your job is to help find customers that have needs and then pair those customers with institutions that can satisfy those needs. But if you bring to the table a level of experience and acumen and understanding of just personal financial statements, the intricacies of financial products beyond the scope of lending, that brings way more to the table than the minimum standard to becoming a mortgage broker. So when it comes to sitting down and having a discussion with a customer and being able to effectively assess their income and dissect their income, understanding revenue, understanding operating expenses and net profit versus gross revenue, and being able to kind of assess risk and present it properly to the lender. I think it makes it more of art than it is a science. It's not just about the ingredients, but knowing how to mix the ingredients together to get that final product. And I think experience makes a huge difference. And I think that's what we bring to the table that the average broker just doesn't have. To your point, there's not too many guys and gals out there leaving behind a career as a banking executive and banking management and decades of experience under their belts to come out and start a business as a mortgage broker. I think that makes a huge difference.
Yeah. No, I mean, for me, I completely agree. Where the bar to getting into the industry is low, and as a result, a lot of even clients may think that a mortgage is only about the lowest interest rate, which it isn't. There's so many moving parts to it that, like, for me, if somebody were to look at your profile, it gives a lot of confidence as to, okay, my future, my mortgage is in the right hands. But to that effect, if somebody were to be working with your brokerage, what's the process? Like, what's your kind of method in terms of getting myself a mortgage or anybody? Do I just give you a call and say, hey, I need a mortgage? And then you say, this is what your options are. What's that entire process that you and your team have to working with you?
That's a good question. I mean, frankly, it's a matter of best fit, right? So, you talked about going to my LinkedIn profile and taking a look at my history and you're talking about confidence. That's a very, very good point. What I tell, everybody who works here, every one of our agents, is that you have to understand that your job is to gain confidence and demonstrate your credibility, show your integrity in that congruence, and then gain trial. Before you can fund a deal, someone has to trust you enough to consider you credible, to want to give you a try. So you should do something that's going to imbue a certain level of confidence. For me, fortunately, I've got 25 plus years of experience. So if somebody goes on really quickly, whether they go onto LinkedIn and take a look at kind of my background and what people have had to say about working with me over the years, or they go on Google and look me up as an individual or look us up as a company, you need to be credible. You need to be able to demonstrate that you have the track record to be able to kind of advise customers, paired with not just surviving a career, but excelling in a career, and also the congruence. I can tell you about kind of where I came from and how I got here, but that doesn't mean that I was very good at it. What have people said about you as you progress and develop your career and build your business? So one of the things that we really focus on in our brokerage is that whole transparency factor. So great, you know what? You've looked at my CV, you've looked at my LinkedIn profile, you've read about us online, and you like it, my experience. The next question is, well, what do people have to say about working with you, right? So consistently throughout my career, I've always solicited testimony. So it's not something I woke up last week and said, I'm going to do this. I've done this consistently. I've done it when I worked as an agent, working for a bank directly as a mortgage specialist. I've done it as a sales manager where people are attesting to myself and my leadership capabilities. And then when you leave all of that behind and you transition to becoming an independent mortgage broker, the question always is, especially when you're removed from selling, and I had been removed from selling and working with clients for a decade. So there's that question of, well, it's nice that he's a banker and he's an executive, but does he have his finger on the pulse? Like, does he understand what's happening in today's market? So all of that history was great building blocks for me transitioning, but I still had to imbue a level of confidence with customers that they were willing to try, and then I was consistent in my execution. And so that's kind of where we levered, social media and client testimony and Google reviews to say, hey, listen, we're good at what we do. We have the track record and the CV to go there, but don't listen to what I have to say. Why don't you take a look at what clients are saying about working with our company? And that makes a difference. So, as far as working with us is concerned, it's as simple as going to our website. We make ourselves as accessible as possible. So, client can go online, they can read about myself, they can read about our agents. They may pick me for, my experience. They may pick another one of my agents because they have a certain linguistic capability, or maybe it's geography. Maybe one of my people are, in 905 and they're in Hamilton, they want to work with the Hamilton agents. There's many reasons as to why a client would pick a mortgage broker to satisfy their financing needs. We give them the access to ourselves, and whether they want to work with me directly, which is super easy to do so. They can send me an email, they can go online. My calendar is fully open, so they pop onto our website, put in a calendar booking, and they can book themselves right into my schedule. So, we work with a lot of clients from various different walks of life, and everyone's super busy. And we want to be able to cater to them, whether they want to meet face to face or virtually through Zoom, or just jump on the phone, and have that discussion. So we've sort of created the infrastructure so that we're easily accessible, and clients can get in touch with us to start that process.
Awesome.
So that's how accessible, we are.
Yeah. So no,
as far as
sorry.
Go ahead.
Sorry, go ahead.
As far as the ingestion process is concerned, essentially what we do is this: we gather all the details on the customer. So there's a lot of misinformation out there. Like, anybody who says you're going to get pre-approved under 60 seconds is not pre-approving you. They're pre-qualifying you.
Yeah.
Right. And so I know I love these, and there's been a couple of institutions, I won't mention names, where they talk about the 60-second pre-approval. Listen, anybody can assess your entire profile in 60 seconds. Is absolutely walking on water. And that's just unreasonable. The amount of time and energy you put into something is going to tell you whether or not that's going to be feasible at the end of the day. One of the things that we do, and I think we put a lot more time and energy into, is that we don't just pre-qualify people, we pre-approve people. Because there are just very good people out there that have no intention of misleading people, but their interpretation of their income and a lender's interpretation of their income could be completely different. I've had self-employed clients come to me and say they make hundreds of thousands of dollars a year, and they're talking about revenue, but the net personal taxable income is like $25,000 a year. So they weren't lying. They weren't intentionally trying to mislead someone. They were talking about their prowess of their business and the revenue they generate for their business. But if I'm generating $250,000 in revenue, operating at a 10% net profit margin, meanwhile I'm only generating $25,000 a year in profit and income, that's significantly different than somebody who's a salary making $250,000. You're not really on par, right? So it's really important to make sure that the people you're working with, first of all, are qualified. They have the experience to assess your needs, right? And they're accurately representing your file to the lender, because what a lot of customers don't really understand is that there's a pre-qualification, which is just an informational assessment of your circumstances. And then there's a pre-approval. And important also in the pre-approval process is that lenders don't make brokers submit files for pre-approval with supporting documentation. So if the individual who's assessing the file doesn't understand the difference, between a notice of assessment and a T1 general, the difference between, a line 150 income and all of the other sublines that feed into line 150, you may be representing this customer to a lender under a premise of you make X, when realistically your earned income is much, much lower than that. So what we don't want to do is give a client a piece of paper that says you're pre-approved, subject to no material change in your information. Meanwhile, you're not even understanding what that information is. So, and you know this better than anybody. People go in the market today to execute a purchase. You can't have a financing condition.
Yeah. No.
So if you're going in firm with hopes of winning in a multiple offer situation, and the person assessing your file didn't do their due diligence to represent your income properly to a lender, you may have false understanding or false sense of confidence in that piece of paper when your deal comes to, when your offer gets accepted and now you've got to go through the motions and satisfy your conditions of financing. All of a sudden, the lenders are asking for all this documentation.
Yeah.
If you didn't take that time to go and do that information up front, now things are going to in your face.
And whenever we have clients at our firm that come in and they say, I'm going to go in firm, what do you think? My first question is like, well, do you know how much you can afford? And they'll come up with a really nice number. And the thing is again, and I agree with you, people aren't lying. A lot of times the market's difficult and they're looking for an answer. And if you have a nice calculator that's going to pre-qualify you in 60 seconds and it says you can afford the moon and back, right? Like you're going to maybe gravitate towards that, when really every dollar is not the same. Every dollar of earned income is not the same. And that qualification has like a lot of like, hey, disclaimers. It has to be earned a certain way. There's like A, B, C, D. And then really you need that pre-approval to really understand where that money is coming for, what that number means, right? What's behind that dollar of earned income, like you just said, to really understand what kind of loan you can process. And if you've, again, gone into a firm agreement thinking you can afford like $2 million or whatever the number is, $1 million, even half a million, and now you realize you can't, you're in a very difficult situation. That's not going to be a pleasant situation. There could be lawsuits. You have to move to like just very expensive borrowing. There's so many other issues that kind of come up that can easily be avoided. And so for me personally, when clients come to me, because I feel like, and you can correct me if I'm wrong, most banks nowadays aren't looking at clients for a pre-approval unless you've got like an agreement that you're entered into, right? If you have a conditional agreement or non-conditional, they're not really going to pre-approve you. They may pre-qualify you. And that puts somebody in a catch-22 where like, okay, what do I do? And I'm like, okay, you got to find a good broker because they're going to put in the time to actually go through all of this stuff. You do not want to be in a situation where you've put in an offer and now you're panicking because the bank just said, no, well, you know what? That's a different number. This is what you can have, right?
Right. That's really important, and I think that's great advice. And one of your questions was, what's your key differentiator? Like, what do you do to mitigate risk? How do you help people get across that hump? And frankly, and to your point, it doesn't matter that I have 50 plus lenders at my disposal. If less than a handful of them are willing to pre-approval file, and even if that pre-approval, it means they're not physically looking at the supporting documentation, you better make sure that that broker that you're working with is actually good at what they do, that they understand the difference between, like, I've had clients come in and go, hey, listen, I've got a notice of assessment, and on my notice of assessment, I made $120,000 last year, right? And, if I'm a brand new broker and I just came into the business and, I know that a line 150 of a notice of assessment is my total earned income, if I don't know what questions to ask, I may take that at face value. And realistically, that client very well could have made $150,000. So if you thought that was all earned income and you made that assumption, or maybe the client even presented it that way to you, hey, here's the deal. What do you need to prove my income? I need this, this, and that. Okay, well, I have my NOA. Will that do? We'll start with that. what you're not realizing is that that line 150 is a cumulative sum of all earned income. So if in that particular year you happen to have some financial hardship and you redeem $30,000 in RSPs, guess what? Your line 150 is $30,000 of RSPT4 income.
Yeah.
If in that same year you had a rental that you sold and you capitalized on, $100,000 in capital gains, you've got capital gains income on that in that income. If on that you had declared some financial hardship and you went and collected CERB, your CERB income is all of a sudden getting factored into play. All of a sudden, that big, giant, juicy number that you had on your line 150 isn't what it was. Right? And so when it comes to working with a professional who's been in the business for a long time, who understand what goes into an income when it comes to your tax documents, makes all the difference in the world, because no two brokers are the same. Right. And so, what we've built, and you talked about, what makes you guys different. And sure, you know what, that gives me a distinct advantage over maybe the average broker. One of the things that we set out to do as a brokerage was help brokers succeed and be better as well. So, when a deal comes in, and whether it's going to come through me or even one of my more newer agents who's newer to the business, myself included, is supported by 3 full-time underwriting staff. And, the person who runs that underwriting team has over 30 years of lending experience and has worked not only as an independent brokerage space, but has actually worked as an underwriter directly working for financial institutions. So, there's always a second set of eyes taking a look at it. So, when you kind of buy into or start working with our brokerage, you're not just getting the experience of the individual like myself, but you're also getting the collective as a whole. And that gives our clients, that gives our business partners a much greater degree of confidence to say, here's why I want to work with this team and these individuals.
And I think a lot of people don't understand that, like, just like every dollar is not the same, every banking condition is not the same, even though the banking condition to its face could be written the same way. What the bank really means behind that could translate into something very different. And it only takes a broker who knows that bank, who knows what like certain conditions really mean, where you can push, where there's no room for negotiation, you're not wasting your time, to really understand where to place that deal. Like for me, it's like there's like banks, for example. I mean, and I don't have anything against big banks. They're wonderful institutions, provide a lot of value, but they don't have all the products. Right now, there's like so many products and that are services products for Canadians, that one bank, just because of regulations, they can't offer everything. Like I work in this space peripherally to the mortgage, right? And looking at stuff, what's an insured mortgage, insurable, uninsurable. There's so many different things going on.
Right.
It takes, I mean, there's no way I can parse through that, especially if I'm going and buying a house and trying to figure that out and really make an intelligent decision. And even with a big bank, it's like for them, again, I'm not knocking on banks, but like if you've got like a shoe size 10 and a 12 and somebody comes in with size 11, you're going to give them a 12, right? And it's like, well, you know what? Like we don't have the perfect size, but it'll fit you. And it's the same thing often with mortgages where they may not have the perfect product for you, right? But it's like it'll fit. With brokers, it's a bit different, right? And again, to your, for example, self-employed conversation, somebody may be declaring $25,000 worth of income. Do you want to declare $100,000, pay more taxes, or maybe you want to move to a different lender and pay a little bit more in interest, right? And where's your overall net worth the greatest 10, 15, 20 years down?
Right. You know what? That's a really good point. And we've challenged the norm. Like, I mean, the reality is Canadian consumers love their banks. It's an oligopoly. It's a handful of players, right? We're not a saturated market, and the confidence is there. The trust is there. The infrastructure is there. having said that, and this is kind of where working with professionals makes a huge difference for us. So, we're not accountants. We don't profess to be, but we've seen a lot of interesting strategies being implemented. So, a lot of times if we're going to see, a customer kind of hit a bit of a glass ceiling where, they can't go any further because of their limitations in personally declared income, and the advice that's being doled out by bankers who are not, they're not accountants. They don't understand the intricacies of the business revenues and retained earnings and what else is going on in the corporation. Their quick band-aid solution is, we'll just declare more income and then we'll make this happen for you, right? However, in a grander financial sense, you take a look at it to say, well, hold on a second. I mean, does it really make sense for me for a year or 2 years to declare a much more significant personal income on funds I've already paid corporate tax on, and now I'm going to pay, personal income tax on this further declared income just for the sake of being able to say I have a lower rate. However, and this is kind of where I love working with accountants. The accountant's going to take a look at this and say, hey, listen, I mean, let's not be penny wise and pound foolish. We're out chasing a rate for the sake of purchasing a home and giving up, tens of thousands of dollars of additional income tax, when we could just, pivot over here and get a slightly higher rate and put ownership within reach to that budget that you wanted to get into that you couldn't because your personal income is X. So, fundamentally making that shift to say, like, here's what we can do. And it doesn't always have to be in the context of self-employed. Sometimes we've had clients hit ceilings where they've got, a nice 9-to-5 job and they own their home, and they've been intelligent about how they've invested in real estate, and, principal residence turned into one rental and turned into 2 rental. And eventually they get to a point where they just can't afford anymore because of conventional lending practices. And then you take a look at it and they're like, well, that's it. That's all I can do. Not true. If you take a look at you talk about a wealth generation strategy or wealth building strategy. If I'm planning on building wealth, you've got to take a look at what are the key contributing factors, right? It's the acquisition of the real estate. So, we've had circumstances where we're sitting in front of real estate clients that have portfolios. In some cases, these are real estate professionals, realtors who have a portfolio, and they've done so, using your conventional institutions, and they've tapped out where they can't go any further. And we take a look at their portfolio and they've got, amazing net worth. However, they're being told we can't lend to you anymore because you've hit a capacity, whether that's based on net taxable income or total number of doors that are owned. And, they feel they don't really have much by way of options. And if we come back to them and say, listen, you've sort of have this approach where, if it's not this price, I'm not going to do it. Well, that doesn't really make any sense, because if you look at how you've acquired this portfolio and what the key factors were, the key factor was the acquisition of the asset. The actual rate differential is such a minute part of this thing. And this is kind of where you can look at historical context of people and say, listen, what if we did this? What if I said to you that if you had come to me 3 years ago, I could have bought 3 properties just like that one by just pivoting to a tier 2 lender that does risk-adjusted pricing. Yes, they do have fees. Yes, they do have a higher rate. But now go back in time and say one of those properties appreciated by 20%, 30% year over year. Some cases it's going to be, much more significant than that. Imagine if we had done that 3 times and what your net position is. And you know what? Like, you kind of just have to challenge their perspective on things to say, had I been able to help you transact more and buy more real estate, would you be further ahead or further behind? And I've yet to meet anyone that said to me, I'd be behind. Because frankly, the market's performed. I mean, you still need to be responsible. You need to make sure that you're maintaining a certain degree of liquidity, whether it's through physical assets or liquidity through tools such as like secured lines of credit. Like, you need to mitigate your risks. But there's more than, there's more than one way to do this.
I think it's
just being open to it.
Yeah, and it's boiling down to, again, like, you have to be responsible. There's no way you're not going to be responsible 100%. And be successful, but you have to be wise, right? You have to be wise where that money's coming in. I've seen people are like, you know what, I'd like to, buy maybe an investment property. but I'm with like this big bank and I can't refinance with them until this situation changes. Well, like again, like you said, real estate prices are increasing 20%. How much are you going to save? Really? Like how much,
Right.
like in order for you to build that generational wealth, you have to be able to really look at everything and plan everything out. What's your outlays, what's coming in, what are
Right.
definitely cash flow, what's the wealth that's going to be generated through the appreciation of the property. And I think
Hmm.
um again, I keep giving this disclaimer. I'm not out for against the banks, but I feel like with banks, the incentive is a little bit different. You're the again for me personally speaking, whenever I go in, I see somebody different. I don't see the same person, right? And so
Right.
how are they going to know what I want? Like some guys will be specializing in residential, some will be looking at commercial only, some of them will be
Right.
like line of credit. It's like, okay, well, I want a mortgage, but then I need a line of credit because my kid's going to college and I can't, and I need
Right.
for that. And then I need to like invest in my own business. Like all of that cannot come from one person at a bank. I feel like with brokers, they get a better understanding of my entire situation, and I can sit down and be
Right.
like, hey, listen, this is where I want to be in 10 years, right? Is this
Hmm.
possible? And you could be like, well, you know what? It is or it isn't. And if it is, this is how it's going to get there.
Right.
It's not going to be like the lowest interest rate. It's going to
Right.
be, this is what you should be expecting. And sometimes what people don't realize, if I were to take this a step further, is an overall, for example, for investors, the lowest rate may not be the lowest rate because maybe to get that third property, that next property's interest rate has to be a little bit higher so you can manage your outflows as opposed to getting the
Hmm.
cheapest one because you're not planning the entire portfolio out.
Right.
So
Right.
that's something that a bank can't really advise you on.
That's a really important thing to not lose sight of. What we tell our clients, and you know what, it's funny, and you'll even see it on our website. We talk about executing a strategy that's going to satisfy today's needs
Yeah.
while being mindful
Yeah.
of your future needs and your future plans. And that's kind of where we sit with clients and say, listen, I can do whatever you want me to do. Like, so if you're saying to me, this is home number one, and in home number, like just having a simple conversation to say, what does home number one mean to you? As in, I'm going to buy it, I'm going to live in it, and in 5 years, I'm planning on selling it, and I'm going to move up to, like, you need to understand what people's plans are beyond just this immediate transaction. Because there's a number of things that will impede that next transaction. There are a lot of people in the GTA today that on paper are worth tons of money, but are insolvent.
Yeah.
So they're home passively. I mean, listen, we're fortunate to live in markets that continue to appreciate at very healthy levels where, what we're worth on paper is not reflected in our bank accounts, right?
Yeah.
And then if you talk about the growth of a portfolio, that's going to be a byproduct of cash flow. So how much money am I making? Well, what's coming in versus what's going out. But on top of that, capital. You need to figure out how you can use that capital to make things work for you. So, and there's some really creative advertising campaigns out there by banks that talk about unlocking the capital in your home and unlocking those resources. Like, governments and policies aren't worried about, people being prudent and investing and growing their worth. They're worried about frivolous discretionary spending, right? So for that intelligent customer who's going to buy that home, who has a reasonable timeline, who says, yeah, I'm going to live here, but realistically in the next 6 years, I'm probably going to grow out of this thing and I'm going to have to get either a townhome or I'm going to get that freehold home or, I'm going to get a bigger home. And you look at that and say, well, if we're having that discussion today, then we should be talking about what the exit strategy is. Is your strategy sell, capitalize on equity, bring it to the new property? Or is your strategy solve for a down payment in that next transaction and potentially hold this as an investment? And if you are going to do that, then your choice of lender changes drastically because the tool in which you use to finance the transaction or the first purchase and your lender of choice could be super important because we may be able to effectively avoid a penalty altogether, re-up when the value goes up, use tools to tap into that equity so that next transaction is solved for without having to worry about penalties and things of that nature. So that's kind of where it's like, don't always chase the rate.
Yeah.
because that lender that you go to who may be just, buying that business because they want that asset on their book, they may not have the complexity in being able to create or have features that allow for you to tap into that equity fairly simply in being able to that next transaction happen. And that's also where you want to qualify the brokers you're working with. You want to find out how much business they do. One of the first things we preach here is don't chase the paycheck. Do right by people, and they will do right by you.
Yeah. Yeah.
And that's a big deal. Like you'll go to Google and you'll read transactions, and we have reviews on Google where people will say, like, these guys are absolutely amazing. Some of these clients we didn't even do a transaction for. They were just benefactors of the advice. And they'll look at us and say, like, wow, that's amazing.
Oh, wow.
I can't believe you're willing to do this for us. And I said, listen, there's a reason. And the reason we're doing this is this. We may not get paid on this transaction, but if we do right by you, chances are you're going to tell other people. And if you do that, you've helped me grow my business. That's the bottom line. More people come back to us, even if we've lost an opportunity, right? You're not going to win every opportunity. Like in a rate inclining environment, if you talk to your bank before you came to me, and that's exactly the kind of environment we're in right now, and that bank happened to hedge a rate before a rate increase, they may have a competitive advantage. Even with all our prowess and all our volume and all our relationships, we may not be able to compete against that. Sometimes just being honest to say, that's an incredible deal, you should take it, just gives them that validation to say, you know what, like, they're not out necessarily just to make a buck. Like, they're just good, honest people.
Yeah.
And you know what? If you look at Google and you read through some of these reviews, there's a very much a theme there about professionals and professionalism and hand-holding and helping people through the process. That's who we want to be. And if you do right by people, they will do right by you.
Oh, that's awesome. I can't add to that. But I do want to, I guess, change gears a little bit. And you're talking about a rate increase environment. We, as you know, earlier this month had Bank of Canada raise interest rates 25 basis points. I mean, there's just a lot of stuff going around. We might get like 7 more rate hikes, 5 more rate hikes. Rates are going to go to the moon. What's your perspective just on the market? Where do you think the rates are going? Where do you see the rates in December 2022?
That's a good question. I mean, it's a crystal ball question.
Yeah.
I mean, I love economists and weather people because they can do all their projections they want, and they're okay to be wrong and still stay employed.
Yeah.
So, I will draw on kind of what we read. And the reality is that inflation is a factor. And the reality is that the only way you're going to kind of curb that is by rate increases. So, when we talk about rate increases, there's 2 types of products. And people are always listening to sound bites and never reading beyond the headlines to find out there are so many other moving parts that you need to be mindful of. So first and foremost, if you take a look at it, I mean, Benjamin Tal is one of the most quoted economists in the Canadian market, super intelligent man that has an acute understanding of the market and where things are going. And coming into the year, no word of a lie, in late spring late fall, early winter, a number of economists had done some projections on what was going to happen with the overnight rate. And projections were anywhere from the aggressive side of 8 rate hikes in a matter of 24 months, and some of the more conservative assessments were going to be like 5 rate hikes over the course of the next 18 months. And as we came into January, Benjamin Tal said, listen, there are a lot of factors here. No one knew what was going to happen in Omicron. That really slowed things right down to a crawl. Numbers weren't quite there. Inflation is a factor, but you looked at what some of the driving forces were behind inflation. And to understand inflation, you need to know kind of the weightings of all the different things that go into it. Crude oil being one of them, and value of real estate value, depreciated value, or maintenance value of homes is a factor that goes in. We actually talk about this on some of the publications that we put out on social. Fact is this: he said, listen, reality is we have to raise rates. Like, there's no question about it. There is, inflation is an issue, and we definitely have to see some hikes happening. And he said, although, kind of we were maybe on pace to do 5 rate increases, his projections were that, by the end of this year, we're probably going to see 3 rate hikes happening, right? And I think what's important to kind of not lose sight of is where we started and where that puts us, right? Pre-pandemic, prime was at 3.95%. In January, Prime was at 2.45%. So that's 150 basis points or 1.5% rate differential. It's pretty significant. And frankly, no one was crying in 2018 or 2019 about rates. They were quite happy with where Prime was. So, frankly, even if you had 4 consecutive rate increases at 25 basis points apiece, that's going to sum up to a total of 1%. So Prime goes from 2.45 to 3.45. The world is not going to come to an end. These rate hikes are absolutely necessary to curb inflation, right?
Yeah.
But it's not going to completely stifle the economy either. Because here's the other thing. The only factor today when it comes to monetary policies is the overnight lending rate. So it's the only way the government can control how much money is available in the system. And obviously that abundance of supply is a contributing factor, one of the contributing factors to inflation. So by raising rates, they're making it a bit more expensive to borrow, which is going to pull some of the speculators out of the equation, and it's going to level things off. So I think it's absolutely necessary for this to happen. But the other thing that you want to be mindful of is also this. The government can't afford to shock the system that basically is stabilizing the economy and preventing, a major depression. So, business loans are prime-based, mortgages are prime-based, secured lines of credit are prime-based. And a lot of these facilities are kind of the capital driving forces behind what's stimulated and maintained our economy through COVID, which lasted 2 years. Right. Yeah. This isn't something anyone could have predicted. So, I mean, frankly, I think it's necessary. And, based on kind of, smarter people than us and their projections, it's not going to be uncommon for us to see at least another 2 rate hikes, maybe 3 by the end of the year. So, if we're at 2.45 in January, we may be sitting at 3.45 by the end of the year, but it's not going to be the end of the world.
Yeah. And I guess as my last question then, given that climate, given what you just said, very well said, right? Would you push clients towards variable or fixed? We've gone back to that traditional.
Yeah, you know what? This conversation comes up a lot, and here's the problem: no one gets past the headlines. Yeah. Everyone always hears the conversation, and the dominant conversation in the last 24 months has always been about what's the Bank of Canada going to do? What's the Bank of Canada going to do? And that's what anyone is talking about. What they don't realize is this: there are completely different variables that drive rates. The Bank of Canada sets an overnight rate, and the overnight rate influences prime, which is what variable rates are based on. However, those variables have nothing to do with what drives fixed rates. And so this is like trying to juggle balls, but keeping an eye on one ball. If you're trying to have that discussion with somebody, you have to be mindful of the fact that they fluctuate at complete different intervals. Let me put things in context for you. Spring of last year, we did fixed rate 5-year mortgages as low as 1.59% for 5 years. Like, that was the holy grail of like the absolute lowest 5-year rate. So here's the funny thing. January of this year, prime was the same as it was in spring of last year. So if all you had your eyes on was 2.45, nothing's changed. But what you don't realize is that fixed rates are based on government Canada bond yields, and bond yields were significantly increasingly. And again, conversation was always about overnight. No one's paying attention to what's happened to fixed rates. So when we came into early part of 2022, and all of a sudden that client that was getting 159 or 179 12 months ago, all of a sudden is getting 259, 279, 299. They had a sticker shock factor. I remember having a conversation with a client who was pre-approved by a bank, and they were pre-approved by their bank at a rate of 1.89 back in early fall, and that's only good for about 120 days. And what they didn't realize is that thing's got an expiry date, and they finally came to fruition. And in February, they ended up buying. And that same customer that was quoted by that one institution at a rate of 1.89, all of a sudden was being offered 2.79. He's like, "What happened?" I said, "You took your eyes off the ball."
Yeah.
What you didn't realize is that your pre-approval is only good for 120 days, and you're in a rate inclining environment, and you've got to execute a transaction in that window of time to capitalize on that rate. And you know what? That ship has sailed. So if we take a look at what's happened, and if you take a look at bond yields, no word of a lie, since the beginning of March till today, we've seen a 75 basis point spike in Bank of Canada 5-year bond yields. So, and that has a direct correlation on fixed rates. So literally in the last 3 weeks, it's been week after week of rate increases. But if all you've been listening to is what's happening in the overnight rate, you're still talking about 25 basis points in February, not what's been happening in fixed rates for the month of March.
Yeah.
So all of that really, really important context to understand. Here's where the conversation goes. The margin between variable rates and fixed rates is so significant that you can't ignore the savings available in variable rates. So if you can get a variable rate that's going to sit at 1.7% for argument's sake, and your fixed rates today are like 3.49%, that's literally doubled.
Yeah.
So if I've got a margin of 150 basis points, what we're telling clients is this: if you're capable of being able to tolerate some risk, the savings is significant. So the advice is this: borrow variable, but pay like it's fixed. Meaning that if you understand the features of a fixed rate mortgage, or even the variable rate mortgage, and how your amortization is calculated. However, your budget permits you to pay like it's fixed. When you take that fixed rate, you literally have to pay a higher amount. However, when you take the variable, you've got a much lower proportion of payment amount because of the lower rate. But the feature on that variable rate may allow for you to gross up your payment, even if it's by $400 a month, to match up to what you would have taken if it was fixed. That's $400 more of payments that you're applying towards your principal that is aggressively reducing your balance. And if you're smart about maximizing on your features, borrow variable, pay it like it's fixed, you're going to get way further ahead than anybody trying to time the market. Does that make sense?
Yep, that's some awesome advice. Thank you for that great conversation. If anybody wants to get in touch with Darren, his contact information is going to be below. Thank you for joining us on the podcast, Darren. Appreciate your time.
No problem. My pleasure. Thank you for having me.